This video is for general educational purposes only and should not be considered financial advice. Investing involves risk, and you should always do your own research before making investment decisions. One of the biggest surprises for new options investors is that option prices don't move in exactly the same way as the underlying shares. Sometimes the shares rise, but the option barely moves. Sometimes the shares hardly move at all, yet the option price changes dramatically. So how are option prices actually determined? In this video, we'll explain the main factors that affect an options premium without getting lost in complicated maths. By the end, you'll understand why option prices change from one day to the next. Before we look at why option prices change, let's quickly remind ourselves what we're buying. When you buy a call or put option, you don't buy the shares themselves. You buy a contract. The price you pay for that contract is called the premium. Just like a share price, the premium changes throughout the trading day as buyers and sellers agree on a price. So the premium behaves much like a share price. It rises, it falls, and it changes every trading day. Unlike a share price, however, an option premium is influenced by several different factors at the same time. The question is, what makes it move? Just like shares, options have two prices. The bid price is the highest price that someone is currently willing to pay for the option. The ask price is the lowest price that someone is currently willing to sell the option for. The difference between these two prices is called the spread. Let's look at a simple example. Imagine an option has a bid price of $4.90 and an ask price of $5.10. The spread is 20 cents. If you immediately buy the option at the ask price and then immediately sell it at the bid price, you would lose the value of that spread. This is one reason beginners sometimes notice they're showing a small loss as soon as their trade is completed. It isn't necessarily because the market moved against them. It's simply because they bought at the ask price and could currently only sell at the bid price. The first part of an option's value is called intrinsic value. You've already seen this in our call options and put options videos. Intrinsic value is simply the amount an option is already in the money. If a call option allows you to buy shares for $100 and those shares are now worth $110, the option already has $10 of intrinsic value per share. If exercising the option wouldn't make economic sense today, the option has no intrinsic value. The second part of an option's premium is called time value. Time value reflects the possibility that the option could become more valuable before it expires. Think about it this way. Imagine two identical options. One expires tomorrow, the other expires in 1 year. Which one would you expect to be worth more? Most people would choose the option with 1 year remaining. Why? Because there is much more time for the share price to move in your favor. More time generally means more opportunity. More opportunity usually means a higher premium. Remember, you're paying for time. The more time your investment idea has to work, the more that time is generally worth. As each day passes, that opportunity becomes smaller. This means the option gradually loses some of its time value. This is called time decay. Time decay happens every day. It doesn't stop because it's the weekend. And it usually accelerates as the option approaches expiration. Even if the share price doesn't move at all, your option may still lose value simply because time is passing. This is why buyers of options have one important challenge. Time is slowly working against them. The size of the spread can also change. For very popular options with lots of buyers and sellers, the spread is often quite small. That makes it easier to enter and exit trades. However, options that don't trade very often may have much wider spreads. A wider spread increases the cost of buying and selling the option and can make trading more difficult. This is one reason many investors prefer options on larger, more actively traded companies. Another important factor is something called implied volatility. Don't let the name scare you. It simply means how much the market expects the share price to move in the future. Imagine Nvidia is about to announce its quarterly earnings. Nobody knows whether the results will send the shares sharply higher or sharply lower. Because traders expect a large move, option premiums often become more expensive before the announcement. Once the earnings are released, that uncertainty disappears, and option premiums often fall. We'll explain implied volatility in much more detail in a future video. Many beginners expect a call option to double if the share price doubles. That's not how options work. Imagine you own a call option. The share price rises slightly. That's good. But another week has also passed. Your option has lost some of its time value. At the same time, implied volatility has fallen after an earnings announcement. The gain from the higher share price may be partly offset by those other factors. That's why option prices sometimes behave very differently from the underlying shares. Think of an option premium like the price of travel insurance. The cost depends on several things: how valuable the trip is, how much time remains before you travel, how much risk the insurance company expects, and how many people are buying similar policies. Option prices work the same way. Several different factors combine to determine the premium. Professional options traders have names for the major factors that influence option prices. They're known as the option Greeks. In a future video, we'll introduce the Greeks and explain what each one measures in simple, beginner-friendly language. Once you understand them, you'll have a much clearer picture of why option prices behave the way they do. If today's video has helped you understand how option prices work and you'd like to learn much more, I've written a book called Profitable Stock Options Trading: Lessons I Learned, Losing $100,000 to Accelerate Your Trading Success. The book goes well beyond today's introduction. It covers real trading experiences, common beginner mistakes, trading psychology, risk management, and practical option strategies that I've developed over many years of investing. If you're serious about learning stock options, you'll find a link to the book in the description below. If you found this video useful, please click the subscribe button. It costs you nothing, but it really helps the channel. Thanks for watching, and I'll see you in the next video.